Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here's your host, Mike Alkin.
Welcome to the podcast. It is Tuesday, June 26, 2018. Hope you had a good weekend. I know you're sick of hearing about my son's lacrosse games and all that stuff, so I'm gonna give you a break this week. We're gonna get right to the action. Sometime within the last month or so, I had Scott Melbye on, and Scott is president of Uranium Energy Corp. He is he advises Uranium Participation Corp, and he's past advisor to the CEO of Kazakh, the state-owned uranium company of Kazakhstan, which is the largest producer of uranium in the world. And those of you who are new to the podcast, one of the industries that I follow very closely, and one of the industries that I invest in is the uranium sector. And so I do speak frequently about uranium, and I had Scott on a while ago, not too long ago, and got great feedback. And since we spoke, there was a Nuclear Fuel Association meeting in Monterey, California that I attended. And it was probably a couple hundred people who really are just focused on the uranium industry, from nuclear fuel buyers to miners to physical traders and other associated people in the industry. And these meetings are a great place to get together and really talk shop and understand what's going on in the industry. And there were 4 investors at the meeting, because you could see the roster of attendees. So it's really nice. It's away from the investment world. And I thought it would be good to have Scott back, where we could talk about what we learned at the meeting, what he learned, what I learned, and we could compare notes, and we could talk uranium. So, we touch upon some things during this coming interview where we talk about Kazakhstan and the depletion rates of the mines in Kazakhstan, and whether or not the cuts that production cuts they instituted were by choice or by necessity. And we talk about the investment or lack thereof going on in Kazakhstan, in the mining operations, in exploration, in development. We're going to touch upon Section 232, which is an action that Energy Fuels and UR Energy, 2 U.S.-based miners, they've asked the Commerce Department to open an investigation on grounds of national security, as to force the U.S. nuclear power utilities to buy 25% of the uranium from U.S. miners, whereas now it's only a couple percent. And we're going to touch on that. And we talk about cash costs, and we this is really a segment focused on uranium. It's something it's a sector that's in a 7-year bear market, or I think the bear market has ended and the bull market's turned. It's just not yet evident in the price, and we talk about that. And so, without further ado, let's just get right to some uranium talk. And I'm going to bring on Scott Melbye. Scott, welcome to the podcast.
Good afternoon, Mike. It's good, as always, to visit with you.
You are back by popular demand. You were on about a month ago or so. And despite the fact you went to Arizona State University, and I went to University of Arizona, despite the fact you went to ASU, people still wanted to hear from you again. So,
well, it's great that you and I have become each other's best friend from the respective universities. Might be our only friends, but it's a great friendship anyway. So if North Korea and South Korea can get together, then I think U of A and ASU can as well.
So, Scott, you are, for those who don't know you, Scott is the president of Uranium Energy Corporation. He is a former advisor to the CEO of Kazakh, the state-owned uranium company, and he also advises Uranium Participation Corporation. Prior to that, Scott spent his entire career, over 25 years, in the sales and marketing arm of Cameco, where he was the president of North American marketing. So this guy has been around the uranium complex for a really long time. And so,
yeah, just to clarify, yeah, I was the president of Cameco Inc., which is the global marketing arm. But yeah,
I apologize. The global, I shortchanged you. I apologize for that. And I thought that the North American thing was a big deal. So Scott was the head of Cameco Global. So Scott, you and I just visited. We had dinner at the Nuclear Fuel Market Conference in Monterey a couple of weeks ago, and it's where a couple of hundred people from the nuclear power industry get together. It's fuel buyers, it's traders of the physical commodity, it's companies, and four investors. I was one of the four, but it's a nice get together where to get a State of the Union, and you've been going to these forever, and I've been going to them for a while, and it's nice to have a benchmark to see how the attitudes of the industry participants are. So, why don't you share with listeners what your takeaway was from the conference at a 30,000-foot view, and then we'll dive into the particulars.
Sure. Yeah, these industry conferences, the uranium and nuclear energy industry, is a pretty small fraternity of people around the world. But this is one of the conferences. It's the World Nuclear Fuel Market Organization, which is a member-run organization of people involved in the fuel cycle. So these would be utility fuel buyers, uranium producers, traders, brokers, analysts, anyone who's involved in the fuel cycle for nuclear energy. I was a former chairman of this organization, so I particularly like this one, and I think it's characterized by a lot of open and frank conversation about the market. So it was good to kind of check in with everybody and see where everyone is at in terms of the market. Some of the bigger takeaways that I got. One was, and it was noted by a number of analysts and utilities and market participants, was the return of a number of the investment community really coming back into our industry and wanting to get a deeper dive into the supply and demand of uranium, who the players are, what's the outlook, and so the fact that there were 4 or 5 hedge funds in attendance at this conference didn't go unnoticed, and I think is something that we're really seeing is kind of the investment community looking at the entry point in our commodity cycle as a very, very attractive for a lot of the fundamental reasons.
Scott, it's so interesting when you bring that up, not to interrupt you, but from my perspective, and it's true, and I felt the same thing. People were saying, do you see how many investors are here? Because, there's a roster of attendees. And when the 4 of us who were there, and we all kind of talked to each other, we know each other, we were laughing, saying, there's nobody here, which we love, because we know that when people do get excited about uranium, it's going to be overflowing with investors. But that shows how starved the uranium industry has been for any attention at all from the investment community.
Yeah, exactly. And I think, it's not surprising. I mean, these are very smart people and invest in various commodities, companies, industries, and they look at the supply and demand fundamentals that have evolved in our unique particular little industry, and they're just amazed at what's kind of unfolding here. And that was, some of the bigger takeaways from the conference. There's a lot of focus and conversation around what's been happening on the production side, and this is something that, Mike, you've been telling your clients and listeners, and something we've been getting that message out there that uranium prices in the $20 range were simply unsustainable. And it's one thing to say that, but still uranium production was continuing year over year until about the peak occurring in 2016, where we really maxed out. And now over the last 2 years, we've seen a dramatic drop-off in global production, over 30 million pounds of annual supply has been taken out of the market as a result of the continued low prices, and more importantly, the catalyst has been the expiration of old contracts that had a great deal of hedged price protection for these producers, and so they're no longer getting $40 or $50 a pound in their contracts. They're forced with selling into a $23 market, and the decision has been for many global mining companies to just shut in production. And some of the big ones that everyone's talking about is, of course, Cameco. With the shutdown of McArthur River in November, I mean, this is like shutting down the Escondida mine in the copper world in Chile. I mean, this is the world's largest operating mine, extremely high-grade Athabasca Basin mine. The shutdown for 10 months was that time period was chosen because of the labor laws within Canada. But we're now getting to the point where Cameco has to make a decision whether to extend that shutdown. And there's a lot of speculation that over the next 2 months, July, August, we'll get some word from Cameco on that decision. And just my observation is that given where we're at and the expense and effort taken to dial that very large conventional mine down, they're not going to be coming back up at the end of this 10 months. So that will be a major catalyst for the market. Also, much has been said about Cameco's backfilling of those contract commitments that are impacted by the McArthur shutdown. They sell over 30 million pounds a year under long-term contracts, so they need to go into the market and cover those commitments. Now, they've chosen very publicly to first draw down some of their excess inventories. They've been carrying about a 12-month forward sales level in inventory, which is higher than the 6 months, which is their normal sort of stated policy level. So they've been drawing down that inventory first, but now they're getting to a point where they need to purchase a very significant amount of material, and that was perhaps made a little more significant by the disclosure that they have entered into a loan with Orano, the former Areva, and their partners in the McArthur River mine, that they will loan material to Orano to help them make their commitments impacted by this. So the drawdown of Cameco's inventory has occurred much faster than it would have on its own. So that really brings us to how much they will buy and when. And analysts have a number of forecasts, but many are kind of coming around the figure of 8 to 10 million pounds or more of material purchased over the next 6 months. That's very significant in the uranium market that probably can't handle 1 million pounds of spot demand given the thinness that we see on the offer side. So this is something everyone in Monterey at the conference was clearly aware of, and folks are focusing on. I think the utilities are more and more focusing on what this means for them and their procurement plan. They had been content to kind of sit back and feed off of a very depressed spot market and make small, medium-term commitments. But at some point here, and that will be another major catalyst when they enter into the market to renew the contracts that are falling off for them as well, we'll see a lot of pressure put on the market as a result.
So, Scott, let's dive into some details here. I want to get into some of the issues that I get asked a lot. You know, I'm pretty public and have a public profile on uranium. So you can imagine, I like you, I get a ton of inbound with people coming at me with, aha, here's where you're wrong. And I love to hear it because I always want to keep challenging my thesis. And, you know, one of the things that I hear a lot about is people say, well, you know, the Kazakhs are a state-owned entity, and even though McArthur River could come offline, big deal, the Kazakhs have extremely low costs. And I often hear people come at me with, well, it costs them $15 a pound, $12 a pound, $10 a pound, $18 a pound. They're all over the place. People just pull numbers out. And they say, and that's why they'll just flood the market. How do you respond to that in terms of the Kazakh costs?
Yeah, well, I think, I think people are drawn to that conclusion because they see some of the most competitive mines in the Kazakh portfolio reporting very low cash costs.
Yeah.
that's wonderful. Those are probably the lowest cost mines in the world, and at the lowest point in the cost curve. But not all the Kazakh operations have the same acid consumption, depths of deposits, other cost inputs. So you probably need to look more broadly at their actions that have occurred really in the last 18 to 24 months. And speaking from someone who was there working with them on their strategy development, they began to feel real pain in a $20 uranium market. And by that, their margins had been squeezed to very low levels that, are not sustainable in terms of everything that they need to achieve in terms of growing the company and being able to support social infrastructure and investments in local communities around the mine. So you saw a very concerted effort begin to really look at their uranium production strategy and start to dial back production. Their strategy is very, there's probably 5 pillars of their strategy, but the first one they looked at was the production cutbacks. And so in 2017, in January of last year, they announced a 10% cut. Now, more recently, their executives have clarified that, well, it looks like in the end that 10% cut was closer to a 5.5% cut. But they've been very transparent and open about it, that they implemented those cuts in January of the year, of the production year, and it was probably too late to impact those 20 mines, JVs. It was a big ship, and it doesn't turn around that quickly. So the good news is they did achieve a 5.5% cut. Also good news is that, they realized that they need to be more consultative with their partners going forward, and that's what they've done in setting out this objective of a 20% reduction from planned output over the next 3 years. So they've been working with their operations and JV partners to achieve that. Now, more recently, and I think it's been reiterated by Kazatomprom lately, the production target for 2018 now appears to be a true cut, not cut from planned production, from what their plans were, but a cut from 2017 levels of about 3.4 million pounds. So, what we're seeing now is a concerted effort to really rationalize production, be more disciplined, show some constraints, and follow through on those objectives. So, this is all, I think they're coming to the conclusion that this is good business. It's good stewardship of their state assets, but it's also an imperative as they move forward on an IPO later this year, early next year, that they can be the biggest impact on the health of the uranium market and price, and they need to do things that are for good business purposes, but also in support of a healthier uranium market. So you're seeing a lot of those actions now coming out of Kazatomprom.
Scott, one of the things you mentioned early in that answer was cash costs, but we know the way they mine is in situ recovery or in situ leach mining, ISL. When they are the costs they have there's a lot of capital involved in those costs. So while cash cost is one thing, there's ongoing maintenance, there's refurbishment of wellheads, and a lot of capital involved. So miners look at an all-in cost. When I think about the Kazakhs' all-in cost, I come up with somewhere in the mid 20s to low 30s, depending on the mine. How far off am I on that?
Yeah, well, given my role there, I can't disclose stuff that's under kind of an NDA agreement. But again, I think you can look at it from, company-wide in terms of their profitability. At $20 uranium prices, margins are squeezed to nothing. So you're right. The injection of solutions at the wellhead is sort of a forward cash operating cost, but there's a lot of well field development, and also there needs to be development of new well fields, new deposits, and that was something that a representative of Uranium One disclosed in a conference earlier this year, that the depletion rate of their resources over the next decade is quite substantial. It could be as much as 40%. So in a sense, they're depleting their resources faster than they're adding to them, and the investments needed to sustain these production levels are significant. So Kazatomprom and Kazakhstan in general was going through a peaking of production under the status quo conditions, but now I think they're looking to kind of bulldoze that peak of production into more of a plateau to spread these resources out longer into the future. So again, another positive bullish point for the market.
That's just something that you touched on. It I think it's personally think from my perspective gets wildly misunderstood on the bear side is, and I had someone on Twitter reach out to me and with this question, and it's something Troy on Twitter, but it's something that I've talked about a lot, which is, with these depletion rates, and if you look at the capital spending of Kazatomprom over the last several years, it's imploded. And, there's been a big decline in CapEx. And so, the question was whether you think the recent cuts are even voluntary or basically involuntary due to the lack of investment to replace what they've been mining. It's almost as though they're going to have a hard time keeping up with these depletion rates.
Yeah. Well, I do. I mean, I think the steps that they have been taking last year and are implementing this year, are voluntary measures that they're making at specific mines and JVs. But had they done nothing and just continued on, there would be involuntary reductions as they just deplete assets. I mean, some of the best mines in the world, I mean, they don't run forever. Akdala, I believe, is one in Kazakhstan that is depleted or will deplete its resources within the next 5 years. And so, that's just something that any resource company, whether it's oil and gas or uranium or anything else, needs to keep an eye on not only the current production levels, but your production sources for the next 10, 20, 30 years. So, they realize that. But I think right now their focus is on what they can do to restore the health of their industry. They realize that producing more and more without any regard to what was the supply and demand conditions present in the market was hurting them, and that they're making much more disciplined decisions going forward. Perhaps another point to talk about, and it probably has even a bigger impact than a 3.5 million pound cut in production this year, is the announced sale of Kazatomprom material to the Yellowcake Fund, the emerging physical fund out of the UK. And it's been announced quite widely that this purchase involved 8.1 million pounds of uranium, which basically puts Kazatomprom in a sold-out condition here for the coming year, which has profound impacts on the market. That's, in my mind, because this material is going into a fund, not a trader. This material goes off the market. It goes in a vault, and it's taken out of the supply and demand picture. So you can consider that 8 million pound sale just as effective as an 8 million pound production cut from Kazakhstan.
And when you think about it, spot market last year was about 44 million pounds. So you're taking out almost 20% from that spot.
Yeah, and and again, it's important. In the spot market, we trade about 40 to 50 million pounds annually. But remember, A lot of those pounds are recycled and passed through many hands over the course of the year. What has the biggest impact are those fresh pounds being introduced into the spot market. So when you turn off that faucet of new pounds coming into the market, whether it's Cameco at McArthur River, whether it's the Kazakhs, or the latest announcement was Langer Heinrich going in care and maintenance in Namibia, that's where you begin to see this accelerated rebalancing that is really the narrative. And I think that, going back to the conference and takeaways, I think that was the biggest takeaway for me, is that this accelerated rebalancing is now happening in a very big way. It's certainly happening faster than we were seeing 2 years ago.
I would argue that from a couple of the last conferences, the mood changed markedly from even 6 months ago, it feels like. Let's talk a couple of big issues that are out there, and it's one that the bears will point to, which is the inventory. And they will look and say, in a market that sells 190, 200 million pounds when you add new reactors in the coming year, inventory $1.8 billion. That's a lot of inventory out there. But talk about the breakdown of inventories and really the mobile aspect of those inventories. Talk about how that works through the system to what's really available for people. Give them a feel for that.
It's important to understand it because, I mean, in our industry, it's fairly easy to determine how much reactors are consuming, and it's pretty easy to determine how much mines are producing. The most opaque factor are those secondary supplies and inventories. And one industry analyst, Uranium UX Consulting, did the work that determined this 1.8 figure that is thrown around. Now, that's a figure of uranium in all forms, all hands, whether it's commercially viable or not, whether it's strategic or pipeline. That is just the gross number, from all sources. But they've also done a lot of work on that, as many other analysts have, and try to unpeel the onion to really look at, well, what are those individual categories that make up that figure, and how liquid are these various categories of uranium? And when you go through that exercise, it's very encouraging, because UX, I believe, concluded that really only 375 million pounds of that 1.8 billion would be considered excess. And they went on to say that even more importantly, in terms of price formation and supply and demand micro market economics, is that only 5 to 10% of that figure, that excess figure, may be available to the market at any given time. And that is consistent with what we see as a commercial manager for UPC. I enter the market to buy material on a regular basis as we raise funds to go out and add pounds to the fund. And I can tell you, it's very difficult to go out and buy 500,000 pounds, 1 million pounds without moving the market. We are not copper or gold, where it is a very big liquid market. It's very thin, and even surprisingly small amounts of demand can move the needle. And so when I heard UXC's sort of explanation behind that inventory figure, it all was consistent with what I'm seeing in the market on a daily, monthly basis.
You know, one of the questions that I often get asked is, okay, we've heard the bull case before, and, why now? And one of the things I point to is a couple of things, and I'd like to get your view on this, is number one, you have a market that is not it doesn't have speculators. It doesn't have financial speculators in there. Unlike any of these commodity markets, you have really one big buyer that buys 95% of all the stuff that comes out of the ground, and those are the electric utilities. And the way the industry is structured, you have the contract market, which historically has been 7 to 10 year contracts. And recently it's moved to a more medium term with 1 to 4, with what the carry trade is called, where the traders will finance shorter term contracts. But real price discovery comes when a utility comes into the market for a contract of size. And because the carry trade, because of very low interest rates, you've had traders willing to finance short-term purchases. And the utilities have been working off of long-term order books before Fukushima and right around Fukushima. And now as these unwind, they need to come to market because they need to secure supply about 2 years ahead of time. And unless they just tap up with some spot purchases, which you just explained is hard to find. And it takes them 2 years before they need it, to the time they negotiate and order it and get it in the form of fuel rods. So that, as long as they've been covered, their needs have been covered, you haven't seen that price discovery. Now, we started to see that in the back half of 2017 with some requests for proposals from the utilities, and they were coming in with some pretty low prices, well below the cost of the average global miner, and nobody really wanted to bid on those. And right. So even with all these production cuts and everything coming out, you haven't seen the utilities step in. So if we look at 2020 and a third of the utilities don't have uranium under contract, that would mean about now they need to come in. Talk about the role of why we haven't seen price discovery and the role Section 232 has played in that? And explain 232 for listeners.
Sure. You're exactly right. When listeners may hear that utilities have needs in 2020 onward, they may say, well, okay, that's a long ways off. Not in the nuclear fuel cycle. I mean, you're normally buying to get the material into the fuel cycle, get it converted, get it enriched, get it fabricated into fuel to your plant. Certainly by this point, you're contracting. We haven't seen that return to the market in a big way from utilities, and it's an interesting phenomenon because utilities had been under, because of high prices in 2005 to 7, and then kind of returning going into 2010. You saw very high-priced long-term contracts signed, and just as they're falling off now for producers and leaving them unhedged, they're leaving the utilities unhedged as well. But they're looking at the low spot prices and this carry trade, which was made very attractive by low interest rates and abundant spot supplies. Well, guess what? Spot supplies are drying up and much more quickly now due to the production cuts and financial players coming into the market, and also interest rates obviously increasing. So that carry trade option doesn't look as attractive. So what's going to happen is this price discovery that you've mentioned will play out, frankly, over the next 12 months, where utilities return to the market and they're going to, go to the producers and say, okay, yeah, I'm ready to sign a long-term contract with you. I want a $30 base escalated contract. And the producers are going to go, well, sorry, it's much higher than that. I mean, they have to price based on what their production costs are, not what a carry trade economic play, buy and hold by a bank or trader will provide. So the utilities will have a choice: either pay the higher price offered by the producer, or say no, that's outrageous, and then they'll have to turn to the spot market. And the spot market then will see increased pressure by near-term buying. So, when you get into this equilibrium and going into undersupply, you begin to see the dynamic where everything kind of spins off of each other to the upside rather than the downside. Now, why the utilities haven't come in sooner, there's a number of reasons for that, but another is the 232 petition that was filed by two producers in the United States. This is the same trade law that has been invoked in aluminum and steel, and now I understand automobiles. But it's not a dumping case under trade law. It's more a national security threat from high levels of import. And so this case has been filed with the Commerce Department, and because of all the other activity in aluminum, steel, and automobiles, Commerce has been slow to react to it. But it does have a bit of it kind of freezes out the utilities in the time being until they really see what the rules of the game will be. So if you're a U.S. utility, you're kind of reluctant to go out and make some big purchases now until you see what, if any, that will impact you. If you're a non-U.S. utility, you're also kind of looking to that as well. So that's certainly something that, Wilbur Ross, the Secretary of Commerce, just spoke publicly within the last day that a decision on that 232 is imminent on whether they will receive the petition and investigate the foreign imports. So we'll just have to stay tuned and see how that plays out. Obviously, Uranium Energy Corp, as a domestic uranium producer with significant license capacity and resources in both Texas and Wyoming.
Yeah, with the 232, what would the rationale be if they didn't pick it up? Paint that scenario. Why would they not pick it up?
Yeah, well, I would have to say that if you look at Trump's position on trade, and one could argue that the national security implications for uranium are greater, certainly greater than I would think automobiles, but perhaps even aluminum and steel. So I would have to believe that the probability of them accepting the case and investigating the imports is quite high. How it is ultimately remedied is anyone's guess at this stage. So I think it's a high probability it will get heard and then goes into a 270-day process of investigating, what's happening and what can be done.
So you've been around this business for a long time, and you have been in this bear market for a long time. And there have been false starts before. how do you gauge where we are today versus 2 years ago when people got excited and, at other points in time throughout this downturn? What is it that you look to that gives you more optimism now than you've had in the past?
Yeah, I think it all comes down to production. Nothing good was going to happen when you had 7 years of declining prices, and production was continuing to increase year over year. And so it really was incumbent on uranium producers around the world to take a look at what they were doing and take a more disciplined, rational approach to production. And I think now that that's happening and happening in a big way, to me, that's your difference right there, because that's how rebalancing is going to occur and accelerate as each primary mine shuts in either permanently or temporarily. You draw down those excess supplies much more rapidly, and that's what's going to ultimately impact the price. So I'm a lot more optimistic of what's happening right now than I've been in a long time. And I think it's also kind of comforting to see some very bright people in the investment community agree with my outlook and are coming in and buying the equities and buying physical, and believe that it's a very enticing entry point for our particular commodity cycle.
Well, the physical is interesting because in the last cycle, and when you look at who was buying the physical, you saw the hedge funds come into the space, but they came in after it was ripping and after it had been breaking out to new highs. And then all of a sudden that momentum brought to the market a bunch of people who wanted to participate in it, and hedge funds buying physical. Whereas now, and I saw this at the conference, we see Yellowcake is filed to buy $160 million worth of, or 170 worth of uranium from Kazatomprom, and they have an option for 100 million for the next 9 years. But there were other real participants there looking to buy physical. And in talking to the people who store this stuff, there seems to be a lot more interest earlier in the cycle. Based on your experience, are you noticing that as well? It's a different point in the cycle that you're seeing it?
Yeah, you're exactly right. In 2005 to 7, the catalyst there were years of underinvestment in production, which we're seeing now, but really brought to the forefront by some supply disruptions, and so the price started to take off, and the hedge funds kind of came in. They didn't light the fire, but they kind of came in, maybe throwing gasoline is a good analogy on a fire that was already lit. In this case, they are getting out kind of ahead of the increase, and so that's just an interesting dynamic. I guess we'll have to see how that plays out. But I guess if I was a utility fuel buyer, I would be taking note of it. And we've been looking at very attractive uranium prices for a number of years now, and I guess they're looking for a catalyst or real signs that it's time to move. I would take that as a pretty serious sign to get out and sign some contracts.
Yeah. Now you have, so having seen all this, what are the things that you say, we could be wrong here? What are the things that you're most attentive to and worried about?
Yeah, I get that question of what do I lose sleep over? I've been watching the deregulated market pressures in the United States very, very carefully. I mean, in the United States, we really have two markets. In the regulated markets of the Southeast, you see very healthy nuclear power plant operations economics. You're seeing plants built down there, but then you're seeing in the Midwest and the Northeast, in the deregulated markets, I call it so-called deregulated markets, nuclear plants under pressure. And what's frustrating is these plants are not uncompetitive by any means. They're 3, 4, 5 cents a kilowatt hour production cost, so that can compete all day long with coal and $3 gas. But what's put them under pressure is the distortion of the billions of dollars of subsidies to renewables. So the least reliable sources of supply are given the first bite of the apple, and the most reliable 24/7 and clean air energy is being impacted and in some cases falling off the bubble. And so that has really concerned me that, there was a point where we could lose, a number of reactors in that deregulated market. What's encouraging to me, though, is that the federal and state governments are taking action. I think it's been shown that when you lose a nuclear power plant, the impacts are dramatic to grid stability, to carbon emissions, to even tax base and rates. So states like New York, Illinois, Connecticut, New Jersey have all passed legislation to kind of level that playing field to not disadvantage nuclear in that marketplace. We're still seeing that play out in Ohio and Pennsylvania, but I think the Trump administration, with some of the actions they've taken, is really kind of imploring those states to take action to save nuclear plants in those states. Those are huge base load sources of supply. But believe me, when we're in a polar vortex situation, the cold winters we've been having, or hurricane conditions, it's been the nuclear power plants that have been the workhorses. So that caused me to lose a lot of sleep. I'm now beginning to see that those concerns are being addressed, and it's both more at the state level, but also being helped by the Trump administration and their policies.
Well, I thank you for joining me. As always,
it's a pleasure.
We will have you back regularly to update us on your view on the markets. And I will see you out at the Sprott conference in July in a few weeks.
Excellent. No, it'll be a good time to catch up. There's a lot happening. The catalysts now are not far out into the future. I mean, we're going to see a lot of data points and catalysts occurring in even the next couple months. So everybody stay tuned.
Great. All right, Scott, it was great talking. Good catching up, and I'll see you soon. Thanks.
Thank you, Mike. Bye.
Well, I hope you enjoyed the conversation with Scott. I always enjoy speaking with him about uranium. He brings a great perspective to it. He's been doing this a really long time, and I've been fortunate in the few years I've been really focusing closely on the uranium sector. I've gotten to know some really experienced veterans who've been through a lot of up and down cycles, and it's great to get that perspective. So I will be bringing more and more uranium talk. My goal is to bring things that are relevant and that can help open open your eyes to different investment opportunities. This podcast is not about finding growth investments. It's not about cryptocurrencies. It's not about a lot of things. It's about the style of investing that I practice, which is deep value, contrarian, out of favor stuff. For my money, the best risk reward I've ever seen is in the uranium sector. So as the weeks and months roll on, I'm sure we'll be spending a lot more time talking about that. And so I hope you enjoyed it, and I hope you have a great week. And I look forward to speaking with you next week. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.